Yes, Tesla's up. I'm a genius. Oh no, Apple is down. I'm such a loser. Yes, Shopify's up. I am amazing. Airbnb is down. What's wrong with me? Welcome back to the channel, guys. If you feel any of those emotions whenever you check your stocks and your portfolios, I feel you. And that's why today we're going to be talking about how many stocks you should own in your portfolio. Because I guess when you're watching this video, either you want to start investing or you're already investing. And if you do, and if you are invested, you probably do the same as I do, constantly checking the stocks, how things are going, reading the news, how's the market developing. And honestly, that can be really overwhelming and stressful. And that's why it's important to really ask yourself, how many stocks do you need to own? Because think about it, if you own one stock, then all you have to do is read up on one company and follow their news, which even that in itself can be quite overwhelming, but obviously much less so than having to do the same for, let's say, 30, 40 stocks, which can really be overwhelming. And if you own, let's say, 40 companies, as great as it feels, you can say I'm a shareholder of all of those companies, and that's amazing. But at the same time, obviously you want to know how your portfolio develops. To catch up with the news, you have to really do a lot of reading. And that's all great and fun, but if you have a second job, I guess none of us are full-time investors. We all do this on the side. So if you have a full-time job or a side hustle or your family to look after, it's really difficult and complex to look after 40 stocks and see what they're doing. Now the question is, of course, why do people choose one or the other? When you think about it, having one company that actually goes up by 20%, you make 20%, and that goes back to risk versus reward. In essence, the more risk you take, the higher your reward. At the same time, the lower your risk, the lower the reward. Also, you have less chance of losing all of it. The extreme case is the casino. When you go to the casino and put everything on one number, and you can have a huge multiplier. I'm not a casino player, so I wouldn't know how much you can win, but I think it's up to 30, 40 times the amount you put. But of course, if that number doesn't come, you lose everything. So in stocks, it's obviously much less risk. Having one stock is great because all you have to do is follow one stock, and if it goes up by 20-30%, that's what you gain and what you make. On the other hand though, if that particular stock, something bad happens, some negative press around it, and the stock drops by 20-30%, well, you're gonna feel the pain right away. And that's why I really believe into diversifying. And that's when it started that people want to own stocks in different sectors, different countries, different industries to spread your risk, to diversify. So even if, let's say, you own some stocks in oil and oil happens to go down, which it has been in the past, you are still good because you're losing some of the stock price over here, but because you own some high growth tech stock and maybe pharmaceutical stocks, those have been going up. So you get some sort of average of those various industries, which hopefully overall is still trending upwards. So you minimize the impact of one particular industry or country that you're exposed to and rather count that the whole market on average grows over time. And that's why people really believe into diversifying the risks and spreading it across different industries, countries and sectors. Do you know how shoe stores diversify their portfolio? They invest in stocks. So that you get an average return, which of course will be lower than if you bet on the winning horse, so to say. In that case, the one company that really had a 30% return. But again, as I said, you also minimize the downside of one particular company doing bad for whatever reasons, and you can really sleep at peace. So of course, all of us probably have a full-time job, so we don't have the time to look after 40 company stock tickers. So there's a great alternative, and these are ETFs, exchange traded funds. Ticker symbols VTI or VOO, there are various out there, really trustworthy, that replicate the S&P 500 or big markets that you want to follow. They're dividend ETFs. Whatever is your investment style, there's an ETF for that, usually very low fees. And that's something even Warren Buffett, allegedly one of the greatest investors of all time, keeps on saying, if you don't know what you're doing in the stock market, invest into ETFs. That's probably the safest bet that often outperforms individual stock pickers over time. Yes, those individual stock pickers may have a good year, 2 or 3, but if you look over 10, 20, 30 year period, majority of the time, the market index, which is reflected by the ETF, actually outperforms those. And at the same time, you have much less worry. You don't have to constantly check the stocks and the news, so you can sleep more peaceful at night, knowing that your money is most likely protected and that you get average, but still very good returns in the long term. Now, if you don't want to go the ETF way, that's totally fine. And it really depends on your investor profile. Are you young in your career? Do you have a small amount of money to invest? The younger you are, probably can take more risk. Currently, I actually own 4 stocks that I really believe in. Yes, I will be adding to my positions in the coming months. I just haven't seen a good buying opportunity, but if it comes up, I want to go up to 10, 15 at most, because if I have to check 40, I just don't have the time for that. 10, 15, I would check on a weekly basis. That allows me to keep on top of it. And again, I'm a long-term investor. I'm not speculating, I'm not day trading. So even if it does dip, I'm not selling the stocks, I will hold on to it. But of course, I want to follow the action and see what's happening. When we look to Dr. Google about what it says, how many stocks a diversified portfolio should consist of, it goes anywhere from 30 to 35 stocks. But again, it really depends on you. Looking after 35 stocks, personally, I think that's a bit of a chore and too much of a time waste that you better allocate towards other things, such as building a side hustle to make more income on the sides. And I talk more about this in the video over here. So yeah, there isn't really a black or white answer. But one more thing I also want to caution you, because traditional banks, when you buy stocks from them, they're actually charging you a commission on every time you buy or sell a stock. So the more you own and the more you go in and out of positions, meaning buying a stock and selling a stock, you're actually incurring commissions, and these can really eat into your profits. That's why I'm really fond of financial minimalism. Less is more. I would rather have one ETF and that be it, and just dollar cost average every month, buying a regular amount every single month, and I would minimize my transaction costs, and I am on top of things. I know at which broker which stocks are, and I can build up these positions over time. And of course, I'm really a big fan of Revolut, that allows me to buy fractional shares. So even if I don't have $2,700, which is the cost for a share of Google at the moment, I can still buy it for, let's say, $100 and own a fractional share of Google if I believe in that company. And I'm not being charged a transaction cost, which is amazing. That's why I really recommend you find the best broker for you that allows you to really minimize any costs on your investment activity. And in this video, I talk more about which broker you should choose if you live in Europe. Guys, one more important thing. Rumor has it that the harder you press the like button, the higher your stock returns will be, apparently. Thanks a lot, guys. Really appreciate it. So in summary, guys, there is no right number. As I said, I'm a financial minimalist, so I really try to stick to no more than 10, 15 at very most. And if I want to diversify more, because I'm still very young, I'm willing to take more risk, especially into high growth stocks where I see big upside potential. But going forward, I also want to start investing more into an ETF. And that's going to be more solid, slow and gradual growth over time. And that's something I want to build up to drive my net worth and really have a safety net for when I'm older. Don't spend all your time researching. This is the typical paralysis by analysis. You overinvest, you over-research, and in the end you end up doing nothing, or wasting your time that you could have invested on your side hustle or building up other sources of income. And let's be real, fundamentals don't matter as much as they used to. Reading the annual reports of the company, studying their balance sheets, it's great, it's good to know that. But today, one big PR disaster for the company or the wrong tweet can send the company stock plummeting. So really, you should be very clear about that. And that's why I say don't spend too much time researching, and then better invest your money into an ETF. Or if you feel like stock picking, then go after 5, 10 and commit to them for the long term rather than moving in and out. With this, guys, I thank you so much for watching. Really appreciate if you give it a like, subscribe to the channel, it means the world to me. And I hope to see you in one of those videos over here. And in the meantime, stay awesome, stay blessed, and I'll see you in the next one. Take care. Ciao, ciao.